Let me ask you a serious question. How many trades have you taken that you knew you shouldn't have taken? Not trades where the market simply went against you. I'm talking about trades where, before you even clicked buy or sell, a small part of your mind already knew. This isn't really my setup, but you entered anyway. Maybe you were bored. Maybe you had just taken a loss. Maybe you saw the market move without you and thought, I need to catch this. Maybe you had 3 losing trades and suddenly wanted one big winner to recover everything. Or maybe you simply broke one of your own rules. And here's the dangerous part. You probably wrote that trade down. You opened your trading journal. You entered the pair. You entered the direction. You entered your entry price, your stop loss, your take profit. Maybe you even attached a screenshot. And then you moved on. But the same mistake happened again the next day, and the next week, and sometimes the next month. So here's the question. If you're journaling your trades but you're still repeating the same mistakes, what exactly is your journal fixing? Because a trading journal isn't supposed to be a diary of everything you did in the market. It is supposed to be a feedback system. A system that takes your behavior, your decisions, your emotions, your execution, and your results, and turns them into information you can actually use. Today I'm going to show you how to build that system. We're going to go far beyond. Entry 1.2345. Stop loss 20 pips. Take profit 40 pips. That's not enough. We're going to build a journal that can answer questions like, why do I keep entering early? Why do I overtrade after a loss? Why do I move my stop loss? Why do I close winners too early? Why do I take setups outside my trading session? Why does my strategy work perfectly in backtesting but fall apart when real money is involved? And most importantly, how do I use my journal to actually change those behaviors? If you're serious about becoming a more consistent trader, don't just watch this video. Build your journal with me. Because by the end, you should have a complete system you can use after every trading session. Let's get into it. The real purpose of a trading journal. Most traders misunderstand journaling. They think the purpose is documentation. It isn't. Documentation is only the first layer. The real purpose is self-diagnosis. Think about it. If you go to a doctor and say, Doctor, I don't feel good, the doctor doesn't simply write, Patient that doesn't feel good. That's documentation. The doctor investigates. What happened? When did it start? What makes it worse? What makes it better? What symptoms repeat? What patterns are visible? That's diagnosis. Your trading journal should work the same way. Your journal should help you diagnose your trading, because trading mistakes are often repetitive. You may think you're making 10 different mistakes, but when you analyze your data, you might discover that they're all coming from one underlying problem. For example, you enter too early. You move your stop. You increase your lot size. You revenge trade. You take low-quality setups. They may look like 5 different mistakes, but the underlying problem could simply be you don't accept being wrong. That's the level at which your journal needs to operate. Not just lost $50, but why did I feel the need to avoid accepting the loss? That's where the useful information is. A journal is not a magic profit machine. Let's clear up another misconception. A journal will not make you profitable automatically. You can have the most beautiful trading journal in the world and still lose money. You can have 50 columns. You can have color coding. You can have charts. You can have screenshots. You can have a spreadsheet with formulas and still lose. Why? Because information only becomes valuable when it changes behavior. That's the key. If your journal tells you you have taken 37 trades outside your plan, and you continue taking trades outside your plan, the journal hasn't failed. You haven't acted on the information. So the goal isn't to create a complicated journal. The goal is to create a journal that makes your mistakes impossible to ignore. Your journal should create a feedback loop. Trade gives record, gives review, gives identify pattern, gives change behavior, gives measure again. That's the system. And we're going to build every part of it, the 5 layers of a powerful trading journal. I want you to divide your journal into 5 major layers. Layer 1, market context. What was the market doing? Layer 2, trade setup. Why did you enter? Layer 3. Execution. How did you actually execute? Layer 4. Psychology. What was happening inside your mind? Layer 5. Review. What did the trade teach you? Most traders only track layers 1 and 2. Some track execution. Very few honestly track psychology. And even fewer actually review their data. That's why the journal never changes their behavior. Let's go through each layer. Layer 1. Market context. Before you record your entry, record the environment. This is extremely important because a strategy doesn't exist in isolation. The same setup can behave differently under different market conditions. You should record things such as trading session, day of the week, instrument, market structure, volatility, major liquidity areas, news environment, higher time frame bias, key levels, whether the market was trending or ranging. Why? Because eventually your journal can reveal something extremely valuable. Maybe your strategy performs well during New York, but poorly during London. Maybe it performs well Tuesday through Thursday, but poorly on Monday. Maybe your setup performs well when volatility expands, but poorly during consolidation. Without market context data, you don't know. You are simply guessing, and trading is already uncertain enough. Don't add unnecessary uncertainty by refusing to collect data. Layer 2. Record the actual setup. Now we get to the trade itself. Every trade should answer one fundamental question. Why did I enter? Not, I thought price would go up. That's not enough. Your entry needs a thesis. For example, price swept previous session liquidity, rejected the level, created a displacement move, and confirmed structure on my execution time frame. That's a thesis. Now you can test it. Your journal should capture entry, stop loss, take profit, risk percentage, position size, risk to reward, setup type, confirmation, entry model, invalidation, expected target. And here's one of the most important fields. Was this trade actually within my rules? Don't make this complicated. Use, yes, no. Because later, when you analyze your results, you can compare rule-following trades versus rule-breaking trades. That comparison can completely change how you see your trading. You might discover that your strategy isn't actually the problem. Your execution is. Layer 3. Execution. Now we're getting into an area traders often ignore. The setup can be correct. Your analysis can be correct. And you can still lose money because your execution was poor. Imagine your plan says, wait for confirmation, but you enter before confirmation. That's an execution error. Your journal should therefore ask, did I execute the plan exactly as written? Not approximately. Exactly. Record. Early entry? Late entry? Correct stop? Stop moved? Partial profit taken? Position increased? Trade closed manually? Trade held according to plan? Did I interfere with the trade? This is where your journal starts exposing habits. Because eventually you may discover, my analysis is actually decent. My execution is the problem. That's a completely different problem to solve. And that's good news. Because now you know what to work on. Layer 4, the psychology section. Now we reach the section most traders avoid. Psychology. And I'm not talking about simply writing, I felt good, or I felt bad. That's almost useless. You need to record the specific emotional state connected to the decision. Before entering, ask, what am I feeling right now? Possible answers: calm, confident, fearful, anxious, bored, excited, frustrated, impatient, revenge-driven, fear of missing out, greedy, uncertain. But don't stop there. Ask, what is this emotion trying to make me do? That's the powerful question. Fear may make you close early. Greed may make you increase your target. FOMO may make you chase. Frustration may make you revenge trade. Boredom may make you manufacture a setup. And confidence can sometimes become overconfidence. So don't just record the emotion. Record the behavior it produces. The 10-second psychology check. Here's a simple technique you can use before every trade. Before clicking buy or sell, pause. 10 seconds. Ask yourself 3 questions. Question 1. Would I take this trade if I had no money to make back today? Question 2. Would I take this exact setup if I had already hit my daily profit target? Question 3. Am I entering because my system told me to, or because I want something from the market? That last question is extremely powerful, because sometimes you're not trading the setup. You're trading your emotional need. You want to recover. You want to prove yourself right. You want to avoid ending the day negative. You want to make money quickly. But the market doesn't care. The market doesn't know what you need. Your journal needs to expose when you're bringing those needs into your decisions. The difference between a good loss and a bad loss. This is one of the most important lessons in trading. Not every losing trade is a bad trade, and not every winning trade is a good trade. Read that again. A losing trade can be excellent. A winning trade can be terrible. Suppose you take a setup that perfectly follows your strategy. You risk 0.5%. The trade hits your stop. You lose 0.5%. That's a good loss. Why? Because you followed your process. Now imagine you ignore your rules. You enter randomly. You risk 3%. The trade happens to win. You make 6%. That is a bad trade. Why? Because the process was broken. If you reward bad behavior simply because it made money, you are teaching yourself to repeat the mistake. That's why your journal needs 2 separate scores: outcome and process. Create a process score. Give every trade a process score from 1 to 10. For example, 10 tenths. Followed the plan perfectly. 8 tenths. Minor execution mistake. 6 tenths. Some deviation from the plan. 4 tenths. Major rule violation. 1 tenth. Emotional gamble. Now compare this against your financial result. You might eventually see something like 10 tenths trades, plus 4.2 R, 8 tenths trades, plus 2.1 R, 6 tenths trades, minus 1.3 R, 4 tenths trades, minus 4.7 R, 1 tenth trades, minus 8.2 R. Now the problem becomes obvious. Your journal isn't just saying, you lost money. It's saying, your rule violations are responsible for most of your losses. That's actionable information. The most important question after every trade. After the trade closes, ask, what could I have controlled? Not, why did the market do that? You cannot control the market. You can control your entry, your position size, your stop, your risk, your patience, your execution, your reaction. Whether you follow your plan, that's where your attention belongs. If the market suddenly reverses and hits your stop, that may simply be normal variance. But if you moved your stop 3 times because you didn't want to accept the loss, that's something you can fix. Your journal must separate market randomness from trader behavior. The mistake classification system. Now we're going to make your journal much more powerful. Create a mistake code. For example, M1, early entry. M2, late entry. M3, FOMO. M4, revenge trade. M5, overtrading. M6, moved stop loss. M7, increased risk. M8, ignored setup rules. M9, closed winner too early. M10, news ignored. Every time you make a mistake, assign it a code. After 20 or 30 trades, count them. Maybe you discover M3 FOMO 8 times, M5 overtrading to 6 times, M6 stop movement minus 2 times. Suddenly your biggest problem is obvious. You're not trying to fix everything. You're fixing the biggest leak first. The weekly journal review. Your daily journal records information. Your weekly review finds patterns. This is where the real transformation happens. At the end of the week, answer. Performance. How many trades did I take? How many winners? How many losers? What was my net R? What was my average R? What was my maximum drawdown? Execution. How many trades followed my plan? How many broke rules? What was my most common mistake? Psychology. When did I feel most emotional? What triggered it? What behavior followed? Market. Which session performed best? Which setup performed best? Which market condition hurt me? Improvement. What is the one behavior I need to improve next week? That final question matters. 1, not 10, because trying to fix everything at once usually means fixing nothing. The one mistake rule. Suppose your journal tells you, you overtrade, you enter early, you move stops, you revenge trade, you close winners early. Which one should you fix? Start with the mistake that has the largest measurable impact. For example, if overtrading cost you 6R this week, while early entries cost you 1R, your priority is overtrading. Don't spend your entire week worrying about the 1R problem. Fix the 6R leak. This is how professional improvement works. You identify the largest recurring source of negative expectancy. Then you attack it. Building your journal template. Now let's build the actual journal. Your main trade log should contain date, time, instrument, session, market condition, direction, setup, entry, stop loss, take profit, risk percent, position size, planned R, result in R, result in money, rule followed, process score, emotion before entry, emotion during trade, emotion after trade, mistake code, screenshot before, screenshot after, lesson. This is enough. You don't need 70 columns. Your journal should be detailed enough to diagnose you, but simple enough that you'll actually use it. Before trade checklist, now create a separate pre-trade checklist. Before entering, confirm, is this my setup? Is the market condition suitable? Is my trading session valid? Is my bias clear? Is my entry trigger present? Is my stop loss location logical? Is my risk within my limit? Is the potential reward acceptable? Am I entering because of my system? Am I emotionally stable? And here's an important rule. If a critical question is nitrogen monoxide, don't trade. The checklist is not there to convince you to trade. It's there to give you permission to stay out. The No Trade Journal. This is a powerful addition. Journal the trades you didn't take. Why? Because sometimes your best trading decision is doing nothing. Record. What setup did I see? Why did I reject it? What happened afterward? This teaches you patience. It also helps you distinguish a missed trade from a disciplined trade you intentionally avoided. Those are not the same thing. If your setup wasn't valid and you stayed out, that's not failure. That's execution. The missed trade trap. One of the biggest psychological problems traders face is watching a trade move. Without them, price runs 100 points. You weren't in it. And your brain says, I should have entered. You start feeling regret. Then you enter the next setup without confirmation. That's how FOMO begins. Your journal should therefore ask, did I miss a valid setup or did I avoid an invalid setup? If you avoided an invalid setup and price still moved, you did not make a mistake. You simply experienced uncertainty. The market doesn't owe you every move. Your job is not to catch everything. Your job is to execute your edge when it appears. Journaling winning trades. Don't only journal losses. Winning trades can teach you bad habits too. Imagine you break your rules and win. That's dangerous, because your brain receives a reward for bad behavior. Your journal should flag that trade. Right, profitable outcome, poor process. This distinction is critical. You don't want to accidentally train yourself to become a gambler. The goal isn't make money at any cost. The goal is build a repeatable decision-making process that has positive expectancy over a sufficiently large sample. Journaling losing trades. Now look at losses differently. Every loss should fall into one of three categories. Type 1. Good loss. You followed the plan. Type 2. Technical error. The setup was valid, but execution was imperfect. Type 3. Behavioral loss. You broke your rules. These three losses require different responses. A good loss may require nothing. A technical error requires skill refinement. A behavioral loss requires discipline and process control. If you treat all three the same, your review becomes useless. The 20 trade sample. Don't change your strategy after 2 trades. This is a major mistake. You take 2 losses. You decide, my strategy doesn't work. Then you change the entry. Take 3 wins. You change it again. Now you have no idea what actually works. Instead, define a sample. For example, 20 trades under the same rules. Track them. Don't modify the strategy every time you lose. At the end of the sample, analyze win rate, average win, average loss, expectancy, maximum drawdown, setup quality, market condition, rule adherence, then make changes based on data, not emotion. Expectancy. Let's talk about expectancy. You don't need a 70% win rate to be profitable. Suppose you win 40% of your trades. Average winner equals plus 3R. Average loser equals minus 1R. Your expectancy is 0.40 times 3R, 0.60 times 1R. That gives you plus 0.60R per trade. That's positive expectancy. Now imagine your strategy has positive expectancy, but you constantly break the rules. Your actual results can become negative. This is why your journal should track 2 things: theoretical strategy performance and actual trader performance. The difference between those 2 numbers is incredibly valuable. Finding your personal edge. Your strategy may have an age, but you also have a personal trading profile. Maybe you're excellent at waiting for liquidity sweeps, trading one specific session, holding trades to predetermined targets, but terrible at trading after losses, trading during low volatility, taking multiple setups in one session. Your journal reveals your personal strengths and weaknesses. This is where trading becomes individualized. Don't just ask, what strategy works? Ask, under what conditions do I personally execute my strategy best? That's a much better question. The revenge trading journaling. Let's take revenge trading specifically. After every loss record, was my next trade part of the original plan? If no, why did I take it? Then record. How much time passed between the loss and the next entry? You may discover something interesting. Maybe your revenge trades happen within 5 minutes of a loss. That gives you a solution. For example, after a loss, mandatory 15-minute cool down. The journal helped you identify the trigger. The rule interrupts the behavior. That's what a journal should do. Stop moving your stop loss. If moving your stop is one of your problems, don't simply write, "Don't move SL." That's not a solution. Identify the trigger. Ask, when do I move my stop? Maybe when price gets close. Maybe after a losing streak. Maybe when you increase lot size. Maybe because you suddenly believe the trade will reverse. Then create an intervention. For example, once the trade is live, stop loss cannot be moved farther from entry. That's a behavioral rule. Your journal identifies the problem. Your trading plan creates the restriction. The daily review. At the end of each trading day, don't spend an hour analyzing every candle. Use a short review. Answer 5 questions. 1. Did I follow my plan? 2. What was my biggest mistake? 3. What was my best decision? 4. What emotion influenced me most? 5. What will I do differently tomorrow? That's enough. 5 questions. 5 minutes. Consistency matters more than complexity. The weekly scorecard. At the end of every week, score yourself. Strategy, setup quality, 10. Execution, rule adherence, 10. Psychology, emotional control, 10. Risk discipline, 10. Patience, ability to wait, 10. Then ask, what score needs the most improvement? If strategy is 9/10 but psychology is 4/10, don't spend the next week changing your strategy. Your strategy isn't the bottleneck. Your psychology is. This is how your journal tells you where to focus. Monthly review. Now zoom out. At the end of the month, analyze the bigger picture. Look at total trades, total R, win rate, average R, largest winning streak, largest losing streak, maximum drawdown, best setup, worst setup, best session, worst session, most common mistake, most expensive mistake, most common emotional trigger, and most importantly, Did my behavior improve compared with the previous month? Because that's the real measurement. Not just your account balance. Your journal should evolve. Your first journal doesn't have to be perfect. Start simple. After 50 or 100 trades, you'll discover new patterns. Then add fields. For example, maybe you discover news affects your setup. Add a news field. Maybe day of week matters. Add it. Maybe volatility matters. Track it. Your journal should evolve based on questions you need answered. Don't add columns because they look professional. Add columns because they help you make decisions. The biggest journaling mistakes. Let's talk about what not to do. Mistake 1. Journaling only winners. You learn nothing about your weaknesses. Mistake 2. Recording only numbers. Numbers without context can hide behavioral problems. Mistake 3. Lying to yourself. If the trade was emotional, write emotional. Don't write the journal question that changes everything. At the end of every week, ask yourself, if I traded exactly the way I traded this week for the next 12 months, where would I end up? That question is uncomfortable, but powerful. If your journal shows constant overtrading, inconsistent risk, revenge trades, strategy hopping, and emotional entries, you don't need another strategy. You need a different process, and the journal gives you the evidence. The 30-day journal challenge. Now I want to give you a simple challenge. For the next 30 trading days, don't focus on making more money. Focus on collecting better data. Every trade, record it. Every mistake, classify it. Every emotion, identify it. Every day, review it. Every week, find the pattern. Every month, measure the improvement. Your goal isn't to become perfect. Your goal is to become more aware, because awareness comes before control. Control comes before consistency, and consistency comes before long-term performance. The 30-day scoreboard. Create 3 numbers. Number 1, rule adherence. What percentage of your trades followed the plan? Number 2, behavioral mistakes. How many mistakes did you make? Number 3, net R. What was your performance? Now compare them. You may discover that as rule adherence increases, behavioral mistakes decrease. And as behavioral mistakes decrease, your results improve. That's the relationship you're trying to uncover. What to do when the journal shows your strategy isn't working. Sometimes your journal will tell you something you don't want to hear. Maybe your strategy doesn't have positive expectancy. That's possible. Don't ignore the data. Separate strategy failure from execution failure. Ask, when I followed the strategy perfectly, what happened? If rule-following trades are consistently negative across a meaningful sample, then you may need to test the strategy. But if rule-following trades perform well, while rule-breaking trades destroy your results, your strategy may not be the problem. Your behavior is. This distinction can save you months of unnecessary strategy hopping. Your trading journal master template. Here's the complete structure. Section A, trade information, date, time, instrument, session, direction, setup, market, condition. Section B, risk, account balance, risk percentage, position size, entry, stop loss, take profit, plan R. Section C, execution, confirmation present, entry according to plan, stop according to plan, target according to plan, any manual intervention. Section D, psychology, emotion before, emotion during, emotion after, main trigger, behavior caused by emotion. Section E, result, win-loss, result in R, result in money, process score. Section F, mistake, mistake code, what went wrong, what could I control? Section G, lesson, what did this trade teach me? What will I repeat? What will I change? That's your core journal. The golden rule. And here's the rule I want you to remember. Don't journal to remember your trades. Journal to understand yourself. Your trading journal should eventually reveal how you behave after losses, how you behave after wins, how you behave when you're bored, how you behave when you're afraid, how you behave when you're confident, how you behave when you miss a setup, how you behave when you are desperate to make money. Because that's where your real trading edge may be hiding. Not inside another indicator. Not inside another strategy. Not inside another YouTube video. Inside your behavior. Final mindset shift. You don't need to eliminate losses. You need to eliminate unnecessary losses. You don't need to eliminate emotions. You need to stop emotions from controlling your execution. You don't need to predict every market movement. You need to execute your setup when your conditions appear. You don't need to win every trade. You need to become consistent in how you make decisions. And that's what a good trading journal gives you. It turns trading from, I think I'm getting better, into, here's the evidence that I'm getting better. That's a massive difference. If you've watched this entire video, don't just close it and say, that's useful. Open your journal. Right now, create your first 5 sections: market, setup, execution, psychology, review. Then take your last 10 or 20 trades and analyze them. Don't judge yourself. Study yourself. Look for patterns. Find the mistake that appears most frequently. Then find the mistake that cost you the most money. And start there. If this video helped you understand trading differently, subscribe to Kontroller FX Ideas, because we're building this channel around something that matters far more than finding another random strategy, becoming a disciplined trader who can execute under pressure. And if you want, comment below. I will journal, not because commenting will make you profitable, but because the commitment means something when you actually follow through. Remember, your trading journal should not simply tell you what happened. It should tell you why it happened, what pattern caused it, and what you're going to do differently next time. Because the goal isn't to become a trader who never makes mistakes. The goal is to become a trader who doesn't keep making the same mistake. I'll see you in the next one. Trade smart. Stay patient. Control yourself before you try to control the market.